Most people think silver risk shows up on a price chart, a spike, a crash, a breakout, a pullback. But history shows something far more disruptive often happens before the chart tells the story. It happens when buyers are ready, money is available, demand is real, and the metal itself becomes harder to source than expected. In that moment, the question is no longer, is silver expensive? The question becomes, is silver available? Today's video is not about hype, predictions, or price targets. It's about how silver markets actually function under stress, why physical availability and paper pricing can diverge, and why several well-documented structural trends suggest that access may matter more than timing in the years ahead. If you've only ever watched silver through charts and headlines, this video may change how you think about the metal entirely. Price versus access. A distinction. Most people miss silver is traded globally in two very different ways. On one side, you have paper markets, futures, derivatives, and financial contracts that reference silver as an underlying asset. On the other side, you have physical markets, bullion, coins, industrial supply contracts, and direct delivery systems. In normal conditions, these two systems appear aligned. Prices move together, supply flows smoothly, and availability feels routine. But under tighter conditions, something important happens. Price and access begin to separate. This is not theoretical. It has been observed repeatedly in commodity markets where supply chains face pressure, including energy, base metals, and agricultural goods. Silver is particularly sensitive to this dynamic because it sits at the intersection of investment demand and industrial necessity. Silver is no longer just an investment metal. For decades, silver was often discussed primarily as a monetary or investment asset. Today, that framing is incomplete. According to publicly available data from industrial research groups and global trade organizations, silver plays a growing role in solar energy manufacturing, electronics and semiconductors, power grids and electrical infrastructure, medical and chemical applications. These uses are not discretionary in the short term. They are tied to infrastructure, energy policy, and long-term industrial planning. That means a growing portion of global silver demand is price inelastic. Buyers cannot simply walk away because the metal is temporarily more expensive. This matters because investment markets react to price, while industrial markets react to necessity and timelines. When those priorities collide, access becomes the constraint. Why supply response is not immediate. A common assumption is that higher prices automatically bring new supply to market. In reality, silver supply is constrained by several factors. Most silver production is a byproduct of other mining operations. New mining projects require years, not months. Recycling capacity is limited and economically sensitive. Public mining data consistently shows that short-term price increases do not translate into immediate production increases. This creates a lag, sometimes multi-year, between rising demand and expanded supply. During that lag, markets must ration availability through other mechanisms, including priority contracts, premium adjustments, delivery timelines. This is how availability pressure develops without dramatic headlines. Paper markets and leverage, a structural reality. Financial silver markets rely heavily on leverage to function efficiently. Leverage increases liquidity, reduces transaction costs, and allows participants to hedge risk. However, leverage also introduces sensitivity to volatility. When volatility rises, margin requirements increase, position sizes shrink, participation becomes more selective. This does not imply wrongdoing or instability. It is standard risk management. But the effect is measurable. Paper volume can contract even while physical demand remains steady or increases. When that happens, paper markets lose some influence over price discovery and physical transactions carry more weight. The shift is gradual, technical, and often invisible to casual observers, but it matters. Regional pricing signals in delivery markets. In delivery-focused markets, price reflects not just theoretical value, but immediate access. In various periods, physical silver prices in parts of Asia and the Middle East have traded at noticeable premiums relative to Western benchmark prices. These differences are influenced by taxes, logistics, and local regulations. But even after accounting for those factors, analysts have noted that delivery demand can produce sustained regional price divergence. This does not mean one market is right and another is wrong. It means different market structures respond to stress differently. And over time, persistent divergence tends to resolve through supply reallocation, pricing adjustments, or changes in purchasing behavior. None of these processes are instant. Why availability? Signals appear before price moves. One of the most misunderstood aspects of commodity markets is where stress shows up first. Most viewers are trained to look at charts, but charts are a summary, not a sensor. In reality, market pressure often appears first in places that don't make headlines: longer delivery timelines, reduced product variety, temporary allocation limits, higher premiums, relative to benchmark prices. These signals do not mean the market is broken. They mean the system is adjusting to demand faster than supply can respond. This distinction is critical because price is often the last thing to move. What physical premiums actually represent? A premium is not simply an extra fee. In physical markets, premiums reflect fabrication capacity, transportation costs, inventory risk, immediate availability. When demand increases faster than these systems can scale, premiums rise even if benchmark prices remain stable. This has been documented across multiple commodities, including energy markets during supply shocks, agricultural markets during seasonal shortages, base metals during infrastructure cycles. Silver follows the same mechanics. Importantly, premiums are local and situational. They do not imply global scarcity. They indicate localized stress within a supply chain. That stress can persist even when paper markets appear calm. Delivery-driven markets as financial benchmarks. Not all markets prioritize the same outcome. Some markets are optimized for hedging liquidity, capital efficiency. Others are optimized for guaranteed delivery, inventory certainty, operational continuity. In delivery-driven regions, price reflects the cost of securing metal now, not the cost of holding a claim. This is why analysts occasionally observe regional price divergence, particularly during periods of strong industrial or retail demand. Such divergence does not imply dysfunction. It reflects different priorities competing at the same time. Over extended periods, persistent divergence usually resolves through increased imports, higher benchmark prices, or reduced demand due to substitution or efficiency, but resolution is rarely instant. Why retail buyers? Notice stress early. Retail buyers sit at the end of the supply chain. They rely on refiners' mints, wholesalers' dealers. When any link in that chain tightens, the effects are felt downstream first. This is why retail markets may experience temporary shortages of specific products, order backlogs, limited mint output. None of these signals mean silver is running out. They mean distribution capacity is under pressure, and distribution pressure often appears well before price adjusts meaningfully. Inventory is not the same as available inventory. A common misunderstanding in metals discussions is the difference between total above-ground silver, silver available for immediate sale. Much silver exists in forms that are locked into industrial products, held as long-term reserves, economically impractical to recycle at current prices. Public industry data consistently shows that availability is a subset of existence. When demand increases suddenly, the relevant question is not how much silver exists, but how much can move at today's price through today's channels on today's timeline. That constraint is what premiums measure. Why paper corrections don't always relieve physical tightness. Another important concept is that paper price corrections do not automatically restore physical availability. In fact, the opposite can sometimes occur. When prices pull back, sellers may hold inventory, buyers may accelerate procurement, fabricators may hesitate to expand output. This can lead to a situation where spot prices decline, premiums remain elevated, availability remains constrained. This dynamic has been observed in multiple commodity markets and is well documented in trade behavior studies. It is not manipulation. It is rational behavior under uncertainty. What this means for market participants. For traders, price volatility is opportunity. For industrial buyers, volatility is risk. For long-term holders, availability consistency matters more than short-term price fluctuation. None of these perspectives are right or wrong. They reflect different objectives. Problems arise only when one perspective is mistaken for the entire market. Silver is increasingly a multi-purpose asset, and markets tend to fragment when an asset serves too many roles at once. Why paper markets matter. Even if you never trade them, many people who buy physical silver assume that futures and derivatives markets have little relevance to them. In reality, paper markets play a central role in price discovery. They provide liquidity risk transfer, short-term price signals. Without these markets, pricing would be slower, more fragmented, and less transparent. However, the structure that makes paper markets efficient in calm conditions also makes them sensitive to volatility. Understanding that sensitivity helps explain why physical and paper markets can temporarily diverge. Leverage is a tool, not a flaw. Leverage is often misunderstood. In futures markets, leverage exists to allow producers to hedge future output, industrial users to manage input costs, financial participants to provide liquidity. Leverage itself is not a problem. It becomes relevant only when volatility rises. When prices move rapidly, risk exposure increases. Clearinghouses adjust margin requirements. Participants must post more capital to maintain positions. This process is mechanical and rules-based. It is designed to reduce systemic risk, not to favor one side of the market. How margin requirements shape participation. Margin requirements determine who can stay active in the market. When margins rise, highly leveraged positions become expensive. Short-term speculative activity declines, position sizes shrink. This does not mean markets are shut down. It means participation becomes more selective. Importantly, margin adjustments often scale with price. As prices rise, the capital required to hold the same exposure increases automatically. This has a subtle effect. Volume may decrease. Price moves may become less smooth. Physical transactions can exert greater influence. This transition is gradual, technical, and often overlooked. Why liquidity can decline even as interest increases. Liquidity is not the same as interest. A market can attract more attention while simultaneously becoming less liquid. And this happens when volatility increases, risk controls tighten, participants reduce leverage. As leverage declines, fewer contracts are used to represent the same underlying demand. The result is a market where price changes can occur in larger increments, moves appear more abrupt, consolidations last longer. This is not instability. It is a shift in how the market processes information. Price discovery under constraint. Price discovery works best when many participants are active. Risk is broadly distributed. Liquidity is abundant. When leverage is reduced, price discovery does not stop. It changes character. Instead of continuous adjustment, markets may pause, reprice in steps, react more strongly to physical transactions. This is particularly relevant for commodities with tight supply chains. In such environments, delivery demand carries more informational weight than speculative positioning. Why this matters. To physical buyers, even if you never trade futures, these dynamics affect you. Because benchmark prices are influenced by paper markets, any shift in liquidity or participation can alter how quickly prices respond to physical conditions. This can result in periods where physical availability tightens premiums. Adjust spot prices lag. Eventually, benchmarks tend to reflect underlying conditions, but not always immediately. Understanding this lag helps explain why physical buyers sometimes feel disconnected from price charts. Misinterpreting market signals. During these periods, narratives often emerge. Claims that demand is weak, assertions that markets are overcrowded, predictions of imminent reversals. These interpretations usually focus on positioning data, not on physical flows. Positioning data measures exposure, not necessity. A reduction in speculative exposure does not imply reduced industrial demand or reduced long-term interest. It simply reflects changing risk tolerance. A market designed for stability, not speed. It is important to emphasize that futures markets are designed to maintain orderly function, reduce systemic risk, absorb shocks gradually. They are not designed to instantly transmit physical scarcity. This design works well in most conditions, but during extended periods of structural pressure, adjustments take time, and that time gap is where divergence can occur. Why history is a tool, not a prediction. When people hear history, they often expect a forecast. That's not how serious analysis works. History does not tell us what will happen next. It helps us understand how systems tend to respond under similar pressures. Commodity markets, in particular, show recurring patterns when demand expands faster than supply, financial participation changes, physical delivery becomes more important. Silver is not unique in this regard. Commodity. Markets and supply lags. Across multiple commodities, documented research shows that supply response is rarely immediate. Examples include energy markets during periods of underinvestment, base metals. During infrastructure expansion cycles, agricultural products following weather-related disruptions. In each case, prices did not adjust smoothly. Instead, markets went through phases. Quiet, tightening, localized shortages, premium expansion, broader repricing. These phases often overlapped and did not follow a predictable timeline. Silver shares key characteristics with these markets, particularly its dependence on long-term investment and production planning, when benchmarks lag real-world conditions. Historical market studies show that financial benchmarks can lag physical reality when leverage is constrained. Risk controls tighten, participation narrows. This has been observed in oil markets during delivery disruptions, natural gas during regional demand spikes, industrial metals during rapid infrastructure build-outs. In these cases, physical transactions influenced pricing before financial indicators fully adjusted. This does not imply inefficiency. It reflects the design priorities of financial markets, which emphasize stability and continuity. The role of inventories in market stability. Inventories play a stabilizing role in commodity markets. However, inventory data often aggregates different forms of supply, does not reflect accessibility or timing, includes material not immediately available. Historical analysis shows that when inventories fall below certain operational thresholds, markets become more sensitive to incremental demand changes. This sensitivity often appears first in delivery premiums, contract terms, supply allocations, price follows later. Silver's dual role in past cycles. Silver has historically occupied a unique position as a monetary asset, as an industrial input. In past periods where both roles were active, markets exhibited higher volatility, faster repricing. Once adjustments began, greater regional price variation. These characteristics are documented in economic studies and market histories without implying abnormal behavior. They simply reflect competing uses for the same resource. Regionalization of commodity markets. Another recurring historical theme is regionalization. When global supply chains operate smoothly, prices converge. When supply chains are strained, markets fragment, local prices reflect local urgency, benchmarks lose some immediacy, access becomes a differentiator. This pattern has been observed repeatedly in commodities ranging from energy to food to metals. It is not permanent, but it can persist long enough to influence investment behavior and procurement strategies. Why retail? Experience often differs from headlines. Historical case studies show that retail participants often experience constraints earlier than institutions. This is not preferential treatment. It is structural reality. Institutions negotiate long-term contracts, have direct supplier relationships. Retail buyers operate within standardized product lines, limited distribution channels, short-term inventory cycles. When systems tighten, retail sees friction first. Misreading historical signals. One common error in interpreting history is assuming that volatility equals excess. In many documented cases, volatility reflected adjustment, not speculation. Markets were responding to shifts in availability, changing participation, structural realignments. Silver's historical behavior fits within this broader commodity framework. Why this is not about buy or sell. At this stage, it's important to pause and clarify something. This discussion is not about telling anyone to buy, sell, or trade silver. Markets are complex, personal circumstances differ, and responsible analysis avoids prescriptive advice. What is useful is understanding how market structure changes decision-making environments. The difference between timing and access. Most market education focuses on timing. Entry points, exit points, pullbacks, and breakouts. Timing assumes that access is guaranteed. In many markets, that assumption holds. But in supply-sensitive markets, access becomes a variable. When access becomes uncertain, perfect timing matters less, consistency matters more, optionality becomes valuable. This is not unique to silver. It appears in energy markets, agricultural inputs, and industrial materials during tight cycles. Why diversification is a stability tool. Diversification is often discussed in terms of assets, but diversification can also apply to market exposure, time horizon form of ownership. Some participants focus on liquidity, others focus on certainty. Neither approach is superior, they serve different objectives. What history shows is that markets reward clarity of purpose, not one-size-fits-all strategies. Volatility is information, not a verdict. Silver is known for volatility. This is often framed negatively, but volatility is simply the market processing competing pressures. In silver's case, those pressures include investment demand, industrial necessity, financial market structure. Volatility does not mean instability. It means multiple forces are active at once. Understanding this helps viewers avoid emotional reactions driven by short-term movement. Why short-term signals can conflict. One of the most confusing experiences for market participants is conflicting signals. For example, prices pull back, premiums stay firm, availability remains tight. This is not contradiction. It is different layers of the market responding on different timelines. Financial markets react fastest. Physical supply chains react slowest. Recognizing this prevents overinterpretation of any single data point. Positioning. As a process, not an event. Many people treat market decisions as events. In reality, effective positioning is a process. Processes allow adjustment learning, reduced emotional stress. They also reduce the pressure to be right at a single moment. This mindset aligns well with markets where supply, demand, and access evolve unevenly. The role of expectation management. A major source of frustration in markets is misaligned expectations, when people expect immediate outcomes, linear movement, perfect signals. They experience disappointment. Markets rarely deliver clarity on demand. Silver, in particular, rewards patience and preparation more than prediction. Why? Extremes are poor guides. Extreme narratives, both optimistic and pessimistic, tend to oversimplify reality. History shows that markets usually resolve tension through gradual adjustment, periodic repricing, structural adaptation, rarely through instant outcomes. Balanced analysis remains the most reliable guide across cycles. Thinking in terms of resilience. One productive way to frame silver exposure is resilience. Resilience means reduced dependency on precise timing, flexibility across conditions, alignment with long-term trends. This approach avoids reacting to every headline and instead focuses on durability, bringing the pieces together. Throughout this video, we've deliberately avoided predictions. No dates, no price targets, no dramatic claims. Instead, we focused on structure. Because structure shapes outcomes long before headlines appear, we explored the difference between paper pricing and physical access, why availability signals often emerge before price adjustments, how leverage, margins, and liquidity influence price discovery, what historical commodity cycles reveal about supply-constrained markets, why positioning is a process, not a moment. Together, these elements form a clearer picture of how silver markets function under pressure. Why this matters more as markets evolve. Global markets today are more interconnected, yet more fragmented, than at any point in recent decades. Supply chains are optimized for efficiency, not redundancy. Financial markets are optimized for liquidity, not delivery. Industrial systems are optimized for continuity, not speculation. Silver exists at the intersection of all three. As a result, its market behavior increasingly reflects real-world constraints, not just financial narratives. This does not imply disruption. It implies adjustment. The shift from price. Watching to market awareness. Many people engage with markets passively, watching prices, waiting for confirmation. Reacting to news market awareness is different. It involves observing availability trends, understanding structural incentives, recognizing early signals without overreacting. This approach does not require constant action. It requires clarity, a simple but important question. So here's the question to sit with, not to answer impulsively, but thoughtfully. If physical availability and paper pricing continue to behave differently at times, which matters more to you, a number on a screen or access to the asset itself? There is no universal right answer, but your answer reveals how you interpret risk, value, and preparedness. Why calm thinking outperforms confident prediction. Market history consistently favors participants who remain adaptable, avoid extremes, focus on fundamentals rather than forecasts. Confidence without flexibility leads to mistakes. Flexibility with understanding leads to resilience. Silver has rewarded this mindset across multiple cycles. Engagement without pressure. If this video added value to how you think about markets, not what to buy, but how to interpret signals, consider subscribing. Not for alerts, not for predictions, but for context. You're also welcome to share your perspective in the comments. Do you focus more on price signals or availability signals? Which do you think markets ultimately prioritize during tight conditions? Thoughtful discussion helps everyone see more clearly. Final thought. Markets rarely change in obvious ways. They change quietly, through incentives, constraints, and structure. Silver is no exception. Whether or not availability becomes a defining factor in the years ahead, understanding how markets behave under pressure is never wasted knowledge. Thanks for watching. Stay informed, stay balanced, and think structurally.